Stop everything you're doing right now and look at the screen, because what I'm about to show you isn't just a market update. It's a fundamental, irreversible shift in the global financial landscape that will change how you think about money forever. I want you to remember exactly where you were and what you were doing when you first understood the magnitude of this moment. And by the end of this video, I need you to go down into the comments and tell me one thing. Are you on the right side of history, or are you about to be left behind? The data is now undeniable, the trend is absolutely explosive, and the story begins right now. According to the most comprehensive and meticulously curated database tracking corporate Bitcoin holdings, BitcoinTreasuries.net, a resource renowned for its organic, real-time aggregation of regulatory filings and corporate announcements, public companies around the globe went on an acquisition spree in the third quarter of 2025 that has shattered all previous records and expectations. They collectively purchased a staggering 195,000 Bitcoins. Let that number sink in for a moment. 195,000. This isn't a typo. It's not a theoretical projection from some crypto influencer. This is cold, hard, auditable data pulled directly from the official financial disclosures of publicly traded entities who are legally obligated to report the truth. At an average acquisition price of approximately $105,000 per Bitcoin, this represents a total capital influx of $20.5 billion flowing into the Bitcoin network in a mere 90 days. To put this into a perspective that is almost incomprehensible, this means that every single day, throughout the entire third quarter, public companies were collectively allocating over $227 million of their shareholders' capital, their war chests, their balance sheet reserves, into this digital asset. This is a velocity of institutional adoption that no serious financial analyst, no portfolio manager, and certainly no individual investor can afford to ignore any longer. This isn't speculative retail money chasing a meme coin. This is the most sophisticated capital allocators on the planet making a deliberate, strategic, and monumental bet on a new global reserve asset. But the raw number of Bitcoins, as eye-watering as it is, only tells half the story. The real narrative, the one that should send shivers down your spine, is found in the who and the why. This wasn't a movement led by a single visionary company like MicroStrategy, which blazed the trail years ago. The Q3 2025 data reveals a breathtaking diversification of adopters. We are seeing massive established players in the industrial and technology sectors, companies you know and likely use every day, making their first ever allocations. We're talking about multinational manufacturing conglomerates, global logistics giants, and even legacy software firms that have been publicly traded since the 1990s, all now deciding that their corporate treasuries are incomplete without a significant allocation to Bitcoin. The reasoning, extracted from their earnings calls and annual reports, is remarkably consistent and points to a collective financial epiphany. The primary driver is no longer just inflation hedging in a vague sense. It has evolved into a precise and urgent strategy of capital preservation against a specific, terrifying specter for any CFO: the rapid, uncontrolled devaluation of their cash reserves held in sovereign currencies like the US dollar, the euro, and the yen. These corporate treasurers are witnessing their cash, the lifeblood of their operations, being systematically eroded by persistent, structural inflation and unprecedented levels of government debt monetization. They have looked at traditional safe havens like government bonds and found them to be returning negative real yields. And they have looked at gold and found its physical settlement and storage to be cumbersome for a digital age. In Bitcoin, they have found an asset with absolute scarcity, verifiable on a public ledger, that is globally liquid, easily transferable, and completely immune to the printing presses of any central bank. It is the ultimate hard asset for the digital century. They are making a calculated bet that the 21 million cap is a more reliable store of value than the promise of any politician or central banker. This is a silent run on the traditional banking system, not by panicked citizens, but by the cold, rational servers of corporate treasury departments. They are converting their rapidly depreciating IOUs from governments into a neutral, apolitical, and globally recognized bearer asset. This is the single most important financial story of our generation, and it's happening right now, while most of the world is still asleep to the revolution. The tectonic plates of global finance have not just shifted. They have been permanently and irrevocably reforged in the fires of this new digital reality. And the implications of this $20.5 billion corporate migration extend far beyond a simple price chart, reaching into the very core of what we consider money, value, and national economic sovereignty. This unprecedented buying pressure from public companies, a force so immense it now acts as a gravitational pull on the entire asset class, has created a fundamental supply shock the likes of which the financial world has never seen. Let's break down the brutal mathematical reality of the situation. With the daily Bitcoin issuance, the so-called block reward, now sitting at a mere 450 coins per day following the most recent halving, the available new supply is nothing short of a trickle. When you juxtapose this tiny daily trickle of 450 new coins against the voracious, corporate-level demand that saw these companies absorbing the equivalent of over 1,400 Bitcoins every single day of the quarter, the arithmetic becomes terrifyingly clear. The public markets were consuming over 3 times the entire global daily production of new Bitcoin. This is an unsustainable supply-demand dynamic that can only lead to one inevitable conclusion: a drastic and permanent repricing of the asset on a global scale. But it gets even more profound when you consider the overall liquid supply. A significant portion of the nearly 20 million Bitcoins in existence are considered permanently lost, locked in inaccessible wallets, or held in long-term cold storage by unwavering believers. The so-called hodlers, who have no intention of selling at any price. This means the actual tradable liquid supply is estimated by many analysts to be only a few million coins. When entities with the buying power of Fortune 500 companies decide to allocate even a single percentage point of their treasury into Bitcoin, they are not just dipping a toe in the water. They are attempting to park a supertanker in a community swimming pool. Their orders are so large relative to the available liquidity that they cannot help but move the market, soaking up every available coin and pushing the price to levels where smaller, earlier investors are willing to part with their holdings. This is not manipulation. It is the pure, unadulterated mechanics of a free market encountering an asset with a perfectly inelastic supply. You cannot print more Bitcoin to meet this demand. You cannot wish more into existence. The protocol is law, and the law of the protocol dictates that there will only ever be 21 million, and the race to acquire a share of that finite digital gold is now being led by the most powerful institutions on Earth. This corporate stampede is also creating a self-reinforcing virtuous cycle, a financial feedback loop that is accelerating the adoption itself. As more companies add Bitcoin to their balance sheets, it legitimizes the asset class for the next wave of adopters, reducing the perceived risk and career liability for any CFO who follows. We are rapidly moving from the era of the pioneer to the era of the pragmatist. Soon, not having a Bitcoin allocation will be seen as the reckless and irresponsible strategy, a failure to protect shareholder value from monetary debasement. This is already beginning to create a stark divergence in corporate performance. Imagine 2 competing companies. One holds a treasury of cash and bonds, watching their real value decay, while the other holds a growing treasury of a scarce, appreciating asset. Which company is better positioned to acquire competitors, invest in R&D, and attract top talent with a stronger balance sheet? The answer is obvious, and this competitive pressure will force every single public company in the world to at least run the models and consider the trade-offs. We are witnessing the birth of a new corporate imperative, and it is coded in cryptography. This is no longer a niche debate. It is a main-stage boardroom conversation. And the decisions made in those rooms are now permanently altering the financial future for every single one of us, concentrating the most sound money ever created into the strongest hands. and creating a new unbreakable backbone for the global economy. So, I have to ask you again, the most important question you will answer today. Where do you stand in this new financial paradigm? Are you actively building your position in the only asset class with a provably finite supply, or are you passively watching as the greatest wealth transfer of our lifetimes accelerates without you? This isn't about getting rich quick. This is about preserving your labor, your savings, and your future in a world where the old rules of money are breaking down in real time. The data doesn't lie. The corporations have made their move. The question is, will you make yours? Let me know what you think. I read every single comment, so tell me down below. What is the one thing holding you back from taking this seriously? Or if you're already in, what was the final piece of evidence that convinced you this was real? Share your story, because your journey could be the one that helps someone else see the light.